After raising rates 11 times in the last year and a half, the Federal Reserve recently decided to temporarily put a pause on the war against inflation via additional rate hikes. Nashville remains the highest ranked region among real estate investors nationwide, and commercial real estate bears the brunt of elevated mortgage rates, with the sector expected to fall yet another 10%, in addition to the previous call for a 15 to 20% correction, according to CBRE. Welcome to my channel. I'm Simon, an investor and licensed real estate agent, and my goal is to bring you the most relevant news and economic data affecting real estate today. All right, let's get started by recapping the events of the past year or so that have led us to where we are today in terms of interest rates. The Federal Reserve has been battling runaway inflation by means of raising the federal funds rate. In addition to raising the federal funds rate, the Fed curbed roughly $95 billion of Treasury and mortgage-backed security bond purchases each month. This is since late 2022, placing pressure on lenders' ability to extend credit. The two main ways for the Federal Reserve, i.e. the central bank, to control inflation is by number one, controlling the overnight federal funds rate, which means raising or lowering interest rates, thereby tightening the credit available to lend out to the public or to other banks. The other way the Fed can control monetary policy is by controlling the money supply, by buying and selling treasuries on the bond market. Now, of course, to some of you, this might seem a little weird. How can the central bank, just another arm of our bureaucracy, buy our own treasuries from the Treasury Department, Central Bank Treasury Department, both federal government entities buying each other's stuff? It's almost like, I don't know, Apple buying back their own stock. That's kind of how that works. So you end up pushing prices up or down based on how you operate your balance sheet. So the Fed has a few tools at their disposal in order to fight inflation, and this is what they've been doing for the past year or so. The federal funds rate, which is set by the central bank, is the interest rate at which banks borrow and lend to one another overnight. Mortgage lenders can then lend money at a slightly higher yield, making a profit in the spread or difference between the two rates. Mortgage lenders typically peg fixed consumer mortgage rates against the 10-year Treasury notes in the bond markets. As the price of the 10-year note declines, its yield will go up until it becomes attractive enough for investors to return and purchase more bonds, thereby bringing down its yield. It is for this reason you will often see mortgage rates increase or decrease on a daily basis based on the performance of these bond auctions. All right, so what does all this have to do with real estate? In March of 2020, the Federal Reserve had cut rates by about 150 basis points, bringing the federal funds rate to virtually 0%. They were giving out free money. That's what that is. When the Federal Reserve decides, or the central bank decides, that they're going to give away money at a 0% interest rate, yeah, it's free money. Why wouldn't you use that? Why wouldn't you use that to lend it out and make a return, or go ahead and buy properties with it? Go buy treasuries. Do something with it, reinvest it. That is the purpose of banks. So what did the banks decide to do? They decided to lend, baby, lend. And consumers decided to buy. Housing prices went up, homes sold at a record pace, and lo and behold, inventory shortages. What are inventory shortages? Let's just look at the simple law of supply and demand. We had a lot of demand, very little supply. That's the meaning of a shortage. Prices go up when something like that happens. So not only were prices going up because homes were selling like hotcakes and you couldn't find a builder that can build homes fast enough to meet that supply, that demand. Well, now the prices have skyrocketed to levels that are, unheard of in some areas. You look at places like California and New York, and $1 million home is worth $2 million. You look at places like Tennessee here, where an affordable home would have been something in the $200,000 range. Now it seems a little unaffordable in the $350,000 range. Just a couple years ago, the interest rates were low enough where people can still afford higher priced homes. Now, however, because of inflation, you're seeing a problem in the market, and that is much higher mortgage rates and higher scrutiny from the banks. So when you want to borrow money from the bank, they're going to drill down and look at your finances through a microscope because they don't want to take the risk. However, homes still have to sell, the market is still booming, and there's still a shortage in inventory. Moving on. Because of all this, here comes inflation. Core inflation metrics, which we're going to cover here today, and I'm not looking at inflation metrics that include food or energy. And the reason for that is because geopolitics, government regulations, and local demographics all impact the prices of food and energy drastically in either direction. And this is going to affect your reading of the CPI, or the Consumer Price Index. Now, at the peak CPI reading, which was in September of 2022, we're talking about the core CPI here, it was at 6.64%. If we were looking at the CPI index that included everything, including food and energy, it would have read 8.9%, and that would have been in June, prior to that September reading. So you can see there's a big difference between with food and energy and without. So we're going to stick with the core because it's a little more precise in its reading. And I'll prove it to you because the latest reading has October, as of end of October of this year, the core CPI has us at a 4% rate of change of inflation. Whereas that same CPI report with food and energy, that again, they fluctuate drastically, had the reading at 3.23%. Remove the food and the energy fluctuations in price, and we're still at 4% inflation. Mind you, the Fed's target inflation is 2%. We're not there yet. However, the Federal Reserve decided to leave rates unchanged for the third time this year. We had in June 14th, rates were unchanged, September 20th, rates unchanged, and November 1st, rates unchanged. 2 consecutive times the Federal Reserve has decided not to raise interest rates. Of course, the decision not to raise interest rates is because they don't want to create a recession. They don't want to wreak havoc on the economy. They need to slow down the inflation without causing a crash. This is what they call a soft landing. Now, I'm a little skeptical of a soft landing. I've never seen one. Maybe it's because I'm too young, or throughout history, there really has never been a soft landing. Altogether, federal officials have raised rates 11 times in the last year and a half, pushing key interest rates to a target range of 5.25% to 5.5%, the highest level in more than 22 years. Here's a chart depicting the Consumer Price Index for all urban consumers, less food and energy. Remember, food and energy are too volatile. They fluctuate too erratically to keep a close eye on important factors like overall cost of living. So here we have a chart depicting the Consumer Price Index, and you can see here that prior to this period, again, this is pre-pandemic, inflation remained steady at a kind of a low rate of about 2% to 2.4%, for example, which is completely manageable. This section here is when the government shut down, and you can see here around the March 2021 up until July of 2022, we hit peak inflation of about 6.8%, roughly. I'm looking at the chart here. And then this is where, of course, these are lagging indicators. So the Federal Reserve can only react to what he's seeing. So now the Federal Reserve needs to fight off inflation as hard as he can, and that means raising rates. Again, he raised rates 11 times in the last year and a half in order to fight this. And we're seeing the result of that. We're seeing inflation come down. The question is, can he bring it down without causing a market crash? That is the main concern here. So we are currently, as of the latest CPI report, at 4% inflation. Again, we have not met the target of 2%, which we were at pre-pandemic. We were around that rate, which is why the Fed did nothing. We just had easy monetary policy throughout. The latest CPI report was released just days ago, as I mentioned before. Now, For those of you who have been paying attention, the stock market rallied in my experience and my personal opinion, I think it's a little exuberant for the stock market to act the way it did in the past couple of weeks. Because here's the thing, the CPI report has the end of October reading at 4.01%. But just the month prior to that, September, it was at 4.13%. A change of 12 basis points. Better yet, let me simplify this to you. A change of 0.1% in the rate of inflation. That's it. The stock market went crazy over that. So the stock market rallied on this news. It's an overreaction in my opinion. They believe that the Federal Reserve is going to continue this holding pattern. He decided to keep rates unchanged 2 consecutive times. They're betting he'll do it a 3rd time and maybe even a 4th. Maybe even he'll start cutting rates, which to be honest, I don't see that happening anytime soon because like I said, we're still at a 4% rate of change of inflation. The Fed's target is 2%. Housing inventory remains tight as current homeowners who've locked in rates at or near record lows hold off on selling their properties. And buyers looking to enter this real estate market are discouraged by elevated home values and high mortgage rates. According to Columbia Business School economics professor Brett House, relief for households isn't likely to come soon, at least not directly in the form of a cut in the federal funds rate. We've talked about the consumer price index. We've talked about inflation. We've talked about how the Fed operates in order to control monetary policy. What does this all mean for mortgage rates? The bond market heavily influences the mortgage market. As I mentioned before, banks like to invest their money either in treasuries or by lending it out on fixed mortgage rates. The longer the better. A 30-year is likely to yield, well, let's take a look. As of November 9th, we're talking on a weekly average here, as of end of the week of November 9th, the 30-year fixed mortgage rate was at an average of 7.5%. Just a couple weeks prior to that, at the end of October 26, week ending October 26, it was at 7.809%. That's a decline of 30 basis points. And let me make something very clear. When people start running scared in the market because of higher interest rates, even though demand still remains high for housing, and then you get a drop of just 30 basis points on a 30-year fixed mortgage rate, you know what that does? It makes people come back into the market and start buying again. And I'll show you. Let's go ahead and take a look at a 30-year mortgage chart. All right, here we have a chart that represents the 30-year mortgage rate pegged against the 10-year Treasury note. As I've mentioned before, these two follow each other quite closely. Here you can see this orange line here is the 10-year Treasury note. This blue line is the 30-year fixed mortgage rate. Now you can see this section here prior to 2022 is before inflation was really hitting. And what you had were stable Treasury note yields and stable mortgage yields. Now you have inflation, and the only real way to control inflation is by cutting the federal funds rate. So you can see here, just a few short weeks ago, the 30-year fixed mortgage rate reached a high of almost 8%. Meanwhile, Treasury yields reached a high of about 5% on the 10-year. All right, what's the point I'm trying to drive home here? What does this all mean for you, the viewer? I mean, after all, I am here to give you some kind of advice, aren't I? Not just information. I don't want to inundate you with information. I want to help you. What this means, it's still a good time to buy real estate. Now, I'm not talking commercial real estate because we're going to get into that in just a minute. I'm talking about residential real estate. You might think, hey, the prices are high. We're going to have a market crash. No, we're not going to have a market crash. The Federal Reserve is navigating inflation pretty well, in my opinion. I don't know if he'll be able to hit the soft landing right on the mark, but he's doing a pretty darn good job. So what I'm seeing here is every time the Federal Reserve pauses with the rate hikes, you get a slight drop in mortgage rates. We're talking, 15 basis points, 30 basis points. But people start diving into the market literally shoveling money into residential real estate, driving prices higher. So if you have an opportunity to buy a house or an investment property at today's prices, it's better to do that than to wait till interest rates come down just a little bit further and pay much higher prices. Again, it's a good time to buy. That's the point we're trying to bring home. Let's move on because we have an interesting headline here from CoStar News that says, Nashville, Tennessee, better known as Music City, is ranked highest in its appeal to real estate investors. In an industry coping with higher interest rates and steady demand, Nashville is ranked #1 for the third straight year in the annual Emerging Trends in Real Estate study by the Urban Land Institute. Here's the top 5 markets, according to their article. #1, Nashville. #2, Phoenix. #3, Dallas-Fort Worth. #4, Atlanta. #5, Austin. Can you tell that all these areas are located in the southwest regions of the United States, where living costs are more manageable compared to places like, I don't know, California, Washington, or New York, where the cost of fuel, food, and shelter are considerably higher due to taxes, deteriorating infrastructure, poor management, and inflation? These top 5 markets are the fastest growing and strongest economies in the nation. And as such, investors will continue to prop up the home values in these markets as long as these areas continue to attract renters and job producers. And I'm going to show you right now, I'm going to pull up a chart. I'm going to show you what rental rates look like across the nation. Here's a chart, data directly from the Federal Reserve, depicting what has been happening to rental rates across the US. Here you go. It just trends in one direction. It just continues to go up. Years on end. This has been going on since the Great Depression, even prior to that. It is a great investment. Real estate will always be a great investment. Now let's move on to another chart that'll show you sort of the year-over-year rate of change in rental rates and why that's significant to you. Here you can see pre-pandemic levels over here. Pre-pandemic. Basically, the rate of change is almost unchanged. That doesn't mean that investors aren't making any money. It means that they're steadily making close to about a 4% rate of increase each year on rent. What happened during the pandemic when the government basically shut down and people didn't have money to make rent? That severely affected rental rates. However, it did make a comeback, a really big one, because you can see here that inflation caused rent to skyrocket because investors were buying up properties left and right, pricing people out and renting those properties for a better rate of return. Real estate will always be the #1 greatest creator of wealth. If there's anything you can walk away with after watching this, it's that. My concern now is not residential real estate. It's the commercial real estate sector and the prospect that most remote workers won't be returning to their offices anytime soon, thanks to readily available technology like Zoom and other cloud services that allow you to basically do your work from home remotely. These workers have been empowered to work from home, and companies were able to cut costs on brick and mortar expenses. High vacancy, high interest rates, and the cost of capital will be the biggest headwinds for commercial real estate market moving forward. As of right now, I'm not concerned that these issues will spill over into the residential real estate market because, like I said, demand is still incredibly high and supply is low. According to CBRE, office vacancy rates in the US are up 18.4% in the third quarter, placing pressure on landlords and borrowing costs, which have contributed to nearly a 21% decline in office prices in the last 12 months through October. Wow. Can you imagine buying an office building a couple of years ago for however many $1 million, only to realize that you would lose 21% of your income from those rental rates? I mean, the valuations alone are going to be affected. The building valuation is affected by the rate of income and the rate of return that it makes for the landlord. Big investors like Brookfield Asset Managers, responsible for roughly $850 billion under management. Wow. This company specializes in infrastructure, private equity, and real estate. They defaulted and literally walked away from buildings. This is Brookfield Asset Management. Liquidity issues further hamper commercial real estate markets as borrowing costs for commercial real estate have risen more than income. Ooh. Thanks to interest rates. Again, rising interest rates make it harder for people to borrow money. So if you're going to buy into commercial real estate, it better not be office buildings because you're not going to be able to afford that interest rate. Exacerbating factors include tighter lending standards. Obviously, the banks are going to have much higher regulations and lending standards than they were at a 0% federal funds rate. There are assets that may never recover even with lower interest rates because they are in cities where the market is deteriorating because of crime and declining demographics, says Shankar Ramakrishnan, I'm sorry if I butchered that name, of Reuters. The market is strained for liquidity. It's in absolute gridlock. Even with a massive drop in valuations in vacant buildings, there is no guarantee you will generate returns to justify the investment. Selling out of an asset is also becoming harder. Either there are no buyers or a limited pool of buyers who demand such a low valuation that existing owners could end up with no proceeds after paying off the loans. Oh my gosh, what a horrible thing to happen. I mean, okay, so we're seeing all these crazy things happening in commercial real estate. I mean, and this issue can become bigger. This can become a much larger issue if we don't stop it now. The current delinquency rate for loans and commercial mortgage-backed securities is 4.76%, but it is expected to approach 10.51% in the coming years. The peak that we touched during the global financial crisis, if you remember, in 2008, according to Moody's Analytics. Wow, this is somber news for the commercial real estate sector. Now, I am an investor in the commercial real estate sector as well, so it sucks to hear all this happening. You just got to be careful. Maybe office buildings are not the way to go at this point. Maybe you want to put your money in an absolute triple net property. That's something we'll cover in a later video. But for now, again, just to drive home the point, residential real estate is the way to go in this market. Forget about commercial real estate for a moment. Even though there's some good deals out there, I would rather focus on residential real estate. Given all the recent economic data coming out of the Federal Reserve and the probability of a major pullback in commercial real estate deals that pose too high a risk for banks and lenders alike, I still see great potential in the residential real estate market. And not just as passive income producing investments, but as an asset to current and future homeowners. Even with elevated interest rates, the demand for housing still remains high. Home buyers and investors will continue propping up home values and even propel them further into the stratosphere if interest rates so much as start to dip in the slightest, which would then place us right back into a vicious cycle of inflation, which would lead to further tightening of monetary policies, i.e. rate hikes. Check out my Instagram and Facebook page for new content and articles posted periodically by yours truly. That's all I have for you today. Please like, subscribe, and share if you felt this information was helpful. Comment and let me know your thoughts. Let me know if there is any topic in particular you are interested in exploring together. See you next time.